Okay, folks, so we are approaching a very, very intense week. In fact, it's going to be so intense your head is probably going to spin. Let's just talk about earnings for a second. From AMC, Workhorse, and Chegg on Monday, Accela, Coinbase, Upstart, Triple D on Tuesday, Neo, Clover, Coupang, EVGO, Blink on Wednesday, Palantir, Baidu, Jivo, Tattoo Chef, Disney on Thursday, and on Friday we have the quarterly 13F filings, which is where institutional investors like hedge funds go and report their biggest holdings. Given the market environment and focus on hedge funds, this is going to have a huge impact. Seeking Alpha ran a study that showed the top 10 stocks from the 40 largest hedge funds since 2016 have dramatically outperformed the S&P 500. Not surprising when you know all the tactics that hedge funds use to win. But nonetheless, understand that a lot of traders look at these 13F filings to find hidden gems. And that's just the tip of the iceberg. There's just so much going on this week, and we love volatility, and we love catalysts. But with all of this in the forefront, you may be asking, hey, Charlie, what are the top 3 stocks for this week? Well, we're going to be talking about just that in this video, along with some updates. And the only thing I ask in return is that you hit that ravishing like button, and also don't forget to subscribe either. Okay, let's go ahead and start very, very quickly with updates. So KIXN was a nice winner from Friday. We got a little bit lucky on this play. We briefed on it 30 minutes prior to market open as a previous multi-runner from earlier this year that had just announced a huge pivot into the EV business in China. This involves not just building out a whole unit dedicated to R&D, production, and marketing, but also the company said that they're in negotiations in terms of mergers and acquisitions. So on this news, speculators were buying this up with images in their heads of this being the next NIO or the next XPEV. I wouldn't say that though. I know NIO, I know XPEV, this ain't no NIO or XPEV. Right now, this is a hype play, plain and simple. And acknowledging that allows you to be a lot more effective in terms of capturing. It sold off a few into open, bounced off the red directional SMA line, and from that bounce at 2, it went to 337, about a 68% run to highs from said bounce. 50% from the briefing. Catalyst plays have been pretty damn slow last week, but putting in the work and showing up every day allows you to be on the front pages when you actually do see things that take. But remember, folks, these are hot rocks. They're fun to toss around, but if you hold them for too long, they burn you. And there's a lot of future potential for the stock. I mean, you look at the opportunities for catalyst runs in terms of future announcements on merger and acquisitions, investments, clarification on EV R&D. There's just a lot of press releases that can come out and cause this to skyrocket again, and we'll keep you updated if we see those. Okay, EVGO. So EVGO, fast charging station provider, took an L last week as the company filed to register millions of shares to be issued in connection to the exercise of warrants. The dreaded D word, dilution. That caused it to break its previous floor at 1034 and hit down to 877 before bouncing back a bit. My thoughts on dilution, it sucks for short-term positions, and it sucks for long-term positions that you're hoping to get lucky on and take profits on. But at the same time, you do have to acknowledge that competing in the EV race is very, very costly. You have to build out infrastructure, you have to build out software, you have to build out partnerships. The beginning of the EV charging race is going to be very, very expensive to build out. And when you're working with early stage companies, you have to acknowledge that. When it comes to the long term, issuing more shares allows companies to build more value out and offer more value to current shareholders, even if they did get diluted in the short run. So I would say yes, disappointed, but also optimistic. Okay, next, so early last week, we briefed on BYSI. It was up on positive data for their lung cancer treatment, and my projection was that strength was likely going to come in multiple waves of positive price action. Now, to be more specific in terms of what that means, there's 2 major types of catalysts in the market. There's BS catalysts that come and don't actually mean anything but rile people into buying a stock. And there's real catalysts that come in that are actually dramatically good for the company. Now, this case, getting positive data for their lung cancer treatment is legitimately huge. Yes, Euphoria came in after that, but when you have a real catalyst, that has real staying power. And oftentimes, if your catalyst falls into the latter stage, which is a true catalyst, then you're going to start seeing residual runs. That is indeed what happened on Friday, and of course, we reiterated it Friday morning as well. Okay, next update, AMC. So Ooga Booga AMC's public stock price hasn't been doing much, but the back and forth routine. Tomorrow, the company will be reporting their earnings. Since AMC doesn't trade based on the fundamentals, but rather trades based on its short squeeze potential, obviously the earnings numbers aren't super duper important. They do matter in the long run for actual valuation, but they don't in terms of the short squeeze. But where there's a little bit of an asterisk is in terms of whether that earnings report is going to rile up retail traders. If you recall, AMC's last earnings report actually marked the floor, which then turned into a 3-month hype storm. Coincidence? Perhaps. But the inherent value in earnings is that it does bring more people into the conversation. And historically, the more attention a meme stock has, the more volatile it trades. And if it goes down, I can already see the media saying, AMC goes down as meme traders are hit with stark reality. If it goes up, you know what they'll say? That's right, crickets. Okay, now moving on to the top 3 stocks. Let's start with Mara, lovely Mara. Crypto has made its latest attempt to the upside thanks to the Bitcoin rallies that took the coin deeper into the 40s. Last week, you had Fidelity taking a 7.4 stake in Mara, showcasing the broader institutional acceptance of Bitcoin as a lucrative business model. What's ironic, though, is that Fidelity taking a stake in Mara, lovely Mara, is really an act of infidelity because guess what? Mara has committed herself to so many of us already. She's quite lovely and she's a little dirty tease. We know that. In all seriousness, though, the institutional adoption of Mara is a huge endorsement of the fact that mining is a very lucrative business model. And a few months ago, we talked about how China cracking down on Bitcoin miners is going to be huge because guess what? When you have less crypto miners, that means that the crypto miners that are still active are that much more profitable. They have less competition and they have better margin. Now, of course, crackdowns on Bitcoin miners also has the effect of killing the valuation of Bitcoin as a whole, temporarily suppressing that demand side. But when Bitcoin's valuation comes back, which it is coming back right now, then you're like, okay, well, hey, all of the remaining miners are becoming very, very profitable. And of course, with Mara being one of the most aggressive Bitcoin miners, even recently announcing they purchased 30,000 Bitcoin miners from Bitmain at the start of the month, it's like, hey, Mara's getting very, very interesting. There's 2 major variables to Mara. You have the supply of miners in the market, which is going down, and then you have the demand for what they mine, which is Bitcoin. As the demand for Bitcoin goes up and the supply stays low, you should see Mara react very, very positively. But if demand goes down again and we see some of that FUD return to the Bitcoin market, that could take longer to realize. But anyways, with Mara's earnings expected to come out on the 13th or the 14th, I'm expecting a beat and I'm looking forward to seeing their guidance for the upcoming quarters. Okay, next, Accela. So exactly a week ago, we talked about how my projection was that Accela, thanks to its incredibly high short interest, its consistent social sentiment boosts in the retail community, the fact that we've had 5+ retail squeeze rallies, and the fact that it was heating up from that last suggests specifically that it was going to rally from the 2s if retail picks up on it. And retail did pick up on it, and that showed some truth early last week. What ended up happening is it ran Monday and Tuesday from that 2.6 to 3.54, which is just shy of 40% up. Then it had a downtrend cycle before picking up again on Friday. Now here's the thing, when we're talking about a short squeeze play, we're not looking for a 40% run. We're looking for something that tops the previous rallies, right? And when we talked about heating up, hey, this upward trend has only gotten hotter and higher and stronger. And when given the high short interest, this is looking very similar to a landmine. The question is, what is going to set off enough buying pressure to step on that landmine and cause a massive explosion that sets off all these short positions? Knowing that Accela is reporting earnings on Tuesday, it seems like we could very well be on the cusp of the next catalyst or opportunity for that to be set off. Okay, lastly, Triple D. So Triple D is a high conviction 3D printing play that we've held our conviction with through both FUD and favor. As you may recall, this was one of the biggest short attack plays out there earlier this year, and it called short sellers bluff by reporting huge earnings back in May, which we covered back then. That set off a storm that caused the stock to run from 18 to 40 within a short time span. But then after it started selling off, and it's a fair amount below those highs. However, we're kind of in this weird area where it's like not super high, and it's not super low. As traders, we don't like things that are stagnant. We don't like things that are right in the middle. We want to buy things that are either really ridiculously extremely cheap or really ridiculously extremely overvalued. On high conviction plays, we buy in at dysphoria and we sell out at euphoria because we know there's always going to be another bad catalyst in the future and there's always going to be another euphoric stage in the future if you have a high conviction in the stock. So heading into earnings, my approach with this is pretty damn stoic. Probably a 60 to 40% chance they report good earnings, but it's much better for us if this gets beat down like a rabid dog. Would it be nice for my ego and fragile feelings if it goes up and beats on earnings? Sure, but it's so much better of an opportunity if this gets beat down like a rabid dog. You look at their scaling into healthcare last quarter with 38% year-over-year beat, you look at industry projections, you look at their growing profitability trend, and it's like, hey, this has earned its spot as a high conviction play. Proof of concept, rapidly growing market. But it just hasn't been doing much in terms of trading opportunities for the last few weeks. And tomorrow is an opportunity for that to change. You consider that DDD has a habit of beating Wall Street's expectations each quarter, and it's like, hey, on one hand, it's likely that they beat again. On the other hand, if they don't beat, that should cause a rapid sell-off. If it doesn't beat this quarter, I'd expect a nice dip to exploit. If it does, I'd expect a nice rally back towards the 40s. Charlie, did you just say that stock can go up or down this week? Ah, genius, Captain Obvious. But taking a step back, predicting on this stock is really, really lazy. And the reason is because predicting only allows you to have a response to one outcome. However, when you have a high conviction play, you could have two different outcomes, which is buy dysphoria and sell euphoria. So based on the outcome of the stock, you have a different reaction. Do I think they're favorite to beat? Yes, 60-40. But that's pretty even odds almost. So it's like, hey, why not just have a plan in place to exploit both realities? That way we don't have to worry about being little dirty magical garden gnomes that can predict everything, and instead just have a plan in place for whatever happens. And again, these are just my predictions. Obviously you want to do your own work so that you can build up your own conviction. You can't get your conviction from other people, because then when things get bad, you're just going to panic sell, you're not going to exploit, and you're going to do things the opposite. And so build your own conviction, make your own plays. Hopefully we have some inspiration on this channel. But at the end of the day, it is your game that you're playing. It's your battlefield, and you have to fight it. Anyways, it's going to be a very, very exciting week, and I'll see you all there. Also, this video is sponsored by the charming gentleman over at ZipTrader U. If you'd like to learn how to trade with our step-by-step lessons, our private chat, and of course, our daily morning briefings, where we brief on all the latest catalysts that we see each and every market open morning, well, I'll go ahead and put the link below with a coupon code that'll get you $50 off. That being said, when I go and buy something, I make sure that I get my money's worth out of it, so make sure to take some time to look over the program and identify whether this is something that you're willing to put a lot of work into, because we want to make sure that you're getting your money's worth out of it, and part of that is really on you. How much you get out of it is really based on how much effort you put into it, and I will put the link below if you want to check it out. Anyways, that caps off the video, and I'll see you in the next one.